Is coming to amalgamation in corporate accounting. Now we are going to discuss about the journal entries in the books of a vendor company. See, in amalgamation, we are required to prepare two sets of journal entries, two sets of books we have to prepare. One is, see, basically you know the meaning. One company is closed, that is liquidated. Another one company is promoted, or another one company is floated. So for the company which is liquidated or closed, we have to close the books of accounts. And another one company is started, floated, then purchasing book, that is purchasing book. Opening entries should be passed in that. So now we are going to discuss about the closing entries in the books of vendor company, that is a selling company. Assume A company is closed and B company is promoted, then vendor is A company and B company is purchasing A company. So B company's books we have to open and A company's book we have to close. So by keeping this as a basic idea, now we are going to proceed the journal entries for closing entries in the books of a vendor company. First one entry is realization account debtor to assets. That is all the existing assets given in the balance sheet. That is existing balance sheet is supposed to be transferred if, or we can put it in this way, what are all the assets taken over by the new company, those assets are transferred to the balance realization account. So what are all the assets the closing company is having, that should be transferred to realization. Obviously the liabilities should also be transferred, but as far as the liability is concerned, we can transfer only the liability to the third parties, that is trade liabilities, bills payable. Only these things can be transferred to realization. As far as share capital, security premium, reserves and surplus, etc., should be treated separately. That will be discussed in the later part of this today's session. Then first one is assets transferred, second one is liabilities transferred. Asset transferred in the sense all assets or debit balances. Now we are going to eliminate it by transferring those things to realization. So debit realization, credit assets. Liabilities or credit balances, now we are going to reduce it, or now we are going to eliminate it by transferring it to realization. So the credit balances of liabilities are debited by cancelling that, debited, realization account is credited. Then third one is a purchase consideration. Who has to pay the purchase consideration? Whatever the method of purchase consideration you are having, either lump sum or payment basis, whatever it may be. If you are having the purchase consideration, that should be transferred to realization. Purchasing company account debtor to realization account. This is, technically speaking, this is provision of purchase consideration. Then fourth one, the purchase consideration is paid. So what we have to do, purchasing company account debtor to realization. Then another one is that payment of purchase consideration. As far as this entry is concerned, that is that fourth entry is concerned, we can take it in two ways. One is that purchase consideration straight away is accounted in realization account in this way, whereas provision entry is made in purchasing company account debtor to realization. There you have to show the payment of purchase consideration, right? So there we have to show the purchase consideration. So in that way also we can show the purchase consideration entry. Then another one is expenses. Sorry, not the expense. This is bank account debtor to realization. What all that? Okay, the next one is, this is the fifth entry is bank account debtor to realization. This is for realization of assets not taken over. Already you are having that assets and liabilities are transferred to realization account. Now if any of the assets are realized, that means which are not transferred, now it is realized, then that should be taken. When you are realizing the asset, debit what comes in? Cash comes in, bank account debtor to realization. Then another one entry is which is a settlement of liabilities. How you are realizing the asset. Likewise, if liabilities are settled, if it is not transferred to realization account, then liabilities are settled. Now realization account debtor to cash or bank. Then another one, next one entry which is expenses. Realization account debtor to bank. See, this expenses entry is given as amortization expense, amalgamation expense, absorption expense, liquidation expense, whatever it may be, whatever may be the term they are using. But if it is the expense and that vendor company is bearing that expense, then you have to pass this entry, realization account debtor to bank. Sometimes the purchasing company may bear the expense, then no separate entry is required in vendor, only that expenses should be adjusted, entry passed in purchasing company, that is opening entries. Then another entry which is preference share capital account debtor to bank and share in purchasing company. This is that settlement to preference shareholders. If you are paying the preference shareholders, if you are settling the preference shareholders, then to whom you are paying? Preference share capital, preference shareholders account debtor to cash will goes out, cash account. Then partly you are settling in shares. So how much shares you are giving preference shareholders, how much cash you are giving. That is the entry for explanation for entry number 8. Then another one which is profit on realization. Realization account is normally nominal in nature. So when you are preparing the realization account, finally settling the realization account, if you are getting the balance, it is supposed to be the profit or the loss. If you got the balance in debit side, then it is a profit. If it is in credit side, it is a loss. The profit or loss that should be transferred to the holders of the shares, that is the owners of the company. So realization account debtor to equity shareholder in case of profit, equity shareholders account debtor to realization in case of loss. Now the final entry here is what are all the assets and liabilities you have not transferred to realization account. Now that those items are supposed to be transferred to the owners of the business. See, you are closing the business. Finally, what you are having, that amount or that those assets are taken over by the owner of the business. Likewise here, share capital you have not transferred, security premium you have not transferred, reserves and surplus you have not transferred to realization account. Now those things are available whereas books are closed. So those things are transferred to owners of the business, equity shareholder. And the final entry is how much amount you are settling to the shareholder, that is equity shareholder, either in the form of the cash or in the form of the shares or both. So shareholders account debtor to bank, shares in purchasing company. In new, when you are paying the shares, how you can pay, how much shares they will get in the new company. So in that way, see, there is a similarity with entry number 12 and entry number 8. Here it is payments made to preference shareholders, there payments made to equity shareholders. So finally the owners, what the amount lying, that is paid to the owners of the business. That's all with this.